How far back can the IRS audit you? The honest answer is 3 years, 6 years, or forever, and which one applies is not up to the examiner. It is written into Section 6501. The default is 3 years from the date the return was filed. Filing early does not help you, because a return filed before the deadline is treated as filed on the deadline. Filing late does move the date, because the clock starts when the return actually arrives. Then there is the 6-year rule. It applies when you omit gross income that exceeds 25% of the gross income you reported. Notice what that test measures. It measures omitted income against reported income. Inflated deductions do not count, and for a business the comparison uses gross receipts before the cost of goods sold. Now here is the part most articles still get wrong. For years, taxpayers relied on a Supreme Court decision called Home Concrete, which held that overstating your basis was not an omission from gross income. Congress reversed that result in July of 2015. An overstatement of basis is now an omission, so it counts toward the 25% test, and disclosing it no longer protects you. If you sold property and your cost records are thin, that is a statute of limitations problem, not just a valuation problem. Then there is forever. There is no deadline at all when the return was fraudulent, or when no return was ever filed. And a substitute for return prepared by the IRS does not start the clock, so that year stays open until you file. One more that catches people with foreign accounts. If a required international form was never filed, a Form 5471, an 8938, or a 3520, the assessment period does not even begin until that form is furnished. Finally, do not confuse this with the 10-year collection clock. Section 6501 limits how long the IRS has to assess. Section 6502 gives it 10 years to collect after the assessment. And no, there is no 7-year rule. 7 years is a filing cabinet habit, not a statute. Tax expert today.